All right, hello everyone, and welcome to the E-Trading Edge question and answer. We cover sleep well portfolio, we cover awake, we cover adapt trades, we cover options trades, pretty much anything and everything. So if you've got a question, throw it in the chat and we'll go for it. Otherwise, we'll probably just crush out a couple that get sent to us kind of on a regular basis, and then we'll go from there. All right, Michelle, what do we have today?
Well, I think the most important thing, and you and I talked about it a little bit earlier, but since then I've also gotten a couple more comments that make me think it's very important.
Mm-hmm.
If you could run us through why it's critical that if there are specific profit targets and stop losses, that we actually stick to them, as opposed to getting excited when we have a little bit of profit and grabbing it early, um, or seeing that it's starting to draw down and freaking out and closing it early. Because I got some comments about both of those things today. And for example, our calendar trade today stuck it out and made money. But I definitely had a few people that chose to close it early,
Oh,
and lost money. So
yeah.
yeah,
Yeah, and anytime you start defying a system, that's when you're gonna start to get hurt. But let's actually explain that through data. That's a perfect example. Um, I think the easiest way to show this is probably just throw it on an Excel sheet, and I can just tune a parameter for like maybe one of our environments for one of the calendars.
yep.
So let me, yeah, yeah, let's do this. Okay. Give me just a second. Let me set this up really quick. It'll take me just a second here. All right. Let me share screen and we'll share a tab. Okie doke. I'm just assuming right now, but correct me if I'm wrong. You're seeing this sheet right here,
Mm-hmm.
this profit and loss target example, right?
Yep.
Okay. So there's a lot of columns in here and stuff like that, but this is just one of our trades, which is just a this is just our calendar trade, our intraday calendar trade, and then we have a lot of other trades as well. But this is a very particular environment. This is a very particular trade parameters, right? And so this is just one of the many of thousands that we've got. But I would just wanted to kind of tweak this one so that way it could at least show the general concept, right? So I'm going to point out a couple of different things on here that are relatively important. Right now, this is our average win. That is actually just calculating over here what our win percentage is when we take it in wins. And then this is calculating our loss average, which is just looking at what our losses are over here in this column. Now, this is over here in this very far column. This is actually like a makeshift kind of like a makeshift portfolio if you're kind of compounding all of your returns and stuff like that. So kind of ignore those numbers right now. But let's just kind of dig into, let's kind of tweak something. So what I did here, because I just wanted to prep a little bit for this question. So what I did here is I basically made this to where if it grabs this this profit, win, and loss per our parameters, right? If it grabs it per our win loss, it will decrease down the win, or it'll decrease down the win if I move this down to a smaller number, right? And it will basically let it run all the way until our parameters hit. So just to kind of I don't want to say all of our parameters because I know that that's kind of part of the system. So if you're a subscriber, you kind of know what I'm talking about as far as not taking it, not using a limit order. But this will actually kind of dig a little bit more into that and why, because we'll kind of go on to two different aspects. So let's just say for let's just say no way that by taking a loss early, right? So this isn't going to be the situation in which you just talked about where someone bailed on a trade early when it was down rather than letting it run, right? So we're not going to use that example because that would be a lot more difficult for me to set up. But what we are going to do is we're going to set up a system in which someone would not let it run all the way to its win. And then we're also going to look at someone not letting it run even past that wind and naturally letting it go to what we talk about in the system, right? So let's first start out. Here we go. So the biggest thing that we're going to focus on is this big blue number over here. So this is just what I'm calling a profit ratio. But in essence, what this comes down to is how profitable is this strategy, right? How profitable for the amount of risk that we're going to put in it? How profitable is it? And you can see here that basically what will happen is when we start tweaking this profit ratio will move up or down based on if we start capping the wins, will it actually end up increasing the returns or not? So, and this is just to kind of generally just kind of throw out what would happen is if we didn't let our winners kind of run a little bit longer. So let's just say this is a full run, right? So this is, going all the way up to 50%, which definitely wouldn't happen. But let's bring this down a notch, right? Let's bring this down to, let's say 20. So this would be a situation in which we're looking for a 7% profit target, but what ends up happening is that profit target is exceeded many times, right? So when it's exceeded, let's say in this situation, we don't let it run a certain amount of time, but we just take it, right? At a 20%. So anytime it exceeds 20%, there's some sort of like limit order and we take it. And you can see already, right? So if I move this back to 50, you can already see our profit ratio gets, pulled down just a little bit because there's actually a couple wins that are even bigger than 20% sometimes. But let's just leave it at 20%. So boom, that brings us down. Now let's go to, let's drop it down even more. Let's drop it down to 15%, right? So now this is capping all of our wins. So you can see over here, you can see how many times we hit 15, 15, 15, 15, 15. So I'm basically capping all of these wins right there at 15. I'm not letting them run anything further, right? And you can see that reduces our profit target, right? And by the way, keep in mind, this exact moment, we're just looking for a 7% profit target. So if we were to put a limit, and let's just bring that all the way down, if we were to just put a limit at 7, right, what does it do to our profit ratio? And keep in mind that we started out, right, letting this completely run its natural course, what we talked about in the trading system. We get all the way up to about a 21 versus if we put in limit orders, we get down to an 8.8. So in this particular environment, it's not this way for all of our environments because there's many of our environments where they're not as sensitive. But in this particular environment that I'm grabbing this example of, if you put in a limit order right at 7 and you take it, right, and you let your broker take the extra, meat on it, basically that we would normally get if we let this, naturally run the way that we talk about, then you basically go from a 21 to an 8.1. So you're basically going to reduce your returns by, 2/3 or so, right? So it's a pretty large reduction. But then let's see if you're like antsy and you can't even make it to the limit order. Well, so let's reduce it down a little bit more. Let's reduce it down to like 4. So now we're starting to cut our wins all the way at 4% profit target. You're at a 1 profit ratio. Keep in mind that a 1 profit ratio is very, very close to 0, and you're most likely not making a lot of money. And it's also, the more you're capping these wins, but yet you're still taking these average losses of 28, it is, yes, it's a profitable strategy, but man, it's just like up, whack, up, whack, and you're just barely treading water the entire time. You're definitely not making the strategy, work for what it was intended, at least in this environment, like I said. And then let's say you're even more antsy and you're like, I'm just going to take any profit that I get, right? And so let's bring it down to 3. You actually end up starting to lose money at that, and actually at a pretty sizable rate, right? If we start capping all of our wins at, say, 1%, you're losing money as fast as we make it in the most profitable situation, right? So taking early wins is just as dangerous as the unfortunate other situation, which is taking a loss instead of letting it run and possibly coming and recovering. So the way that we've tuned all of our strategies, right, and the way that professional traders, the way that we deal with these types of things is that we have very strict parameters within our trading systems. So that way, and they're derived through data, right? They're derived through a historical precedence in something that is fundamental to the trade. So we've got our environmental indicators on this. So we've got a lot of different facets that are coming in to derive, okay, what type of environment are we in? And that way we know what our parameters are per that environment. And then we've tuned them from that, right? By the way, I haven't reduced any of the win percentages from this, right? So keep in mind that those limit orders, right, just as we talked about before, those limit orders do reduce your profit ratio. It doesn't mean that the strategy is totally screwed or anything like that. It's still profitable. It's just not going to be as profitable. And then if we let things run their natural tendency, yes, we're still looking for a profit target of, X amount. In this situation, we're looking for 7%, but we let it go up just a little bit further, or we let it kind of move around and kind of breathe for a second before we close the trades out. And that's important. And you can see the difference between that limit order and, let's say that you try to grab it and it's fine, you're going to pull it at like, maybe an 8%. Like I said, you're still profitable, but you're going to, in this environment, you're going to definitely chop your returns maybe in half. Maybe not nearly that bad, but especially if you're using limit orders right there, you're definitely going to come down to this because the broker will definitely take your money. So, and then they'll get the extra spread on it. Exactly what we were talking about. So, yeah, it's important to let them run. It's important to make it to your profit target. It's important to not even just make it to your profit target, but let it breathe through the profit target in this environment. In this case, not all of our environments are like that. I'm going to preface that again. A vast majority, I'm talking 95% of our environments, they're not as sensitive as this particular one. So I'm really just I'm cherry picking an environment that's really sensitive to letting it breathe. So hopefully that kind of goes down. Michelle, I know that you and I have talked about this a ton of times. So do you have anything to add here?
Well, I think the point is, big picture, know that you're going to be um, taking those big losses every once in a while. And it's not very often, but every once in a
Right.
while, you're going to be taking that big loss. So you need every bit you can get on the days where things go your way to offset that
Right.
loss. And then the leftover is what your profit is. So you want to make sure you're
Right.
getting every bit of the leftover you can.
Yeah. I mean, you just don't want to put yourself at a disadvantage for the system. I mean, that's the whole thing is that if you're following a system, especially a system that someone else has designed and made available to you, right? And you have that in your tool bag. If you're tweaking it before you start tweaking something, you would need to know every element of that strategy, right? And because of how capitalism works and because of how our business model works, you're not going to know every facet of our trading systems, right? So if you're a trade designer yourself or a trade engineer or you're working in finance or something and you're starting to work this yourself, then you can start tweaking some things and kind of knowing what's going on. But if you don't have all of the information, you definitely can blow up an account pretty quickly by changing small things. I mean, this was just a profit target that we were changing there, but if we start changing something like maybe allocations, right? Putting too much allocation in some time frames, putting not enough in others because we feel good about the trade or whatever like that, and we start to defy risk management. Yeah, I've seen many, 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 many traders, and I know of a couple that are current right now too that defy trade sizes and are moving them around and are trading big some days and trading small other days, or trading flat amounts every day and just putting in a certain amount of risk, and it changes results very dramatically because that's one risk, that's one element to our risk models. And every trade has that, by the way, not just ours. If you have any kind of a trade, they they have times where you really do need to not have as much risk in the trade, such as like broken wing butterfly strategies in late 2021 or something like that, right? That's a harder time.
Yeah, and I think on the loss side of things as well, we kind of covered the letting your winners run. On the
Hmm.
loss side of things as well, oftentimes these draw down and then come back for a full profit or for even some of the better profits. And the I think it's a natural inclination to think, well, if I only take the good ones, so like I cap these losers at 10%, because if it's gone
Hmm.
10%, surely it's not coming back enough of the times to make it worth it. I feel
Hmm.
like that's a natural thing to feel like that could be possible, but it's not actually accurate. We've gone through thousands of instances, and the 25% mark under this environment is where it's no longer worth it because not enough are coming back. But at 24%, enough come back that it's worth keeping it open. Like that's why the number is set where it's set, is because that is actually the place that is worth it or not to take that risk.
Absolutely.
So
Absolutely. Once you hit that cliff, right? Once it goes beyond a certain, loss target, um, that's when it's like, okay, statistically, it's probably not going to come back at this point, right? Whereas, and I mean, you can use other elements. Like there are some strategies that are like, we're going to use technicals to determine if a trade has gone too far, or we're going to use, gamma structures, or we're going to use, I mean, like, so if you're in like something like Adapt Advanced, right? You're very well aware that we have, structural limits. At the same time, we also have market limits, right? So we're using market limits, structural limits. Also, we're using the indicator for limits, right? We're also using macros for limits. So we've got all these limits built into the trade to keep us in this optimal positioning as much as humanly possible. And then, of course, there's a little bit of subjectivity around it if you want to design something that kind of fits your trading style a little bit more, but you're using all of those elements. So every type of trade has different types of elements that limit its risks, and by limiting your risks, that's how you actually make the returns at the end. Anyone can just throw out a lottery ticket out there, but very rarely will that lottery ticket pay out. And over time, the market is very, very good at sniffing out people that do not have good risk management. It'll make you take excessive losses. It'll make you suck on hope for your trade is going to come back, and then it'll just suck everything out of it, type of thing. It's take your losses when they're supposed to, take your winners when you're supposed to, but each trade is different. So something like our calendar trades and things like that, not even our calendar trades. There's other, well, here we'll just talk about it in general, right? Some trades need asymmetric risk reward ratios, right? So where you're getting 10-to-1 reward to risk because their probability is so low. But then at the same time, you've got the other side of the spectrum where maybe your probability is a lot higher. And so you can use that or you need that asymmetry on the other side to keep your probability high. So everything's got this kind of fine sweet spot in the like this probability expectancy curve of where to be. And it's important to not let your emotions kind of get in there. And that does happen. I mean, I remember when I was a newer trader, I would get excited about things, or, I didn't even have limits when I was a new trader. I was just like, that feels good. Yeah, we're going to do that one, and then we're going to take it quick, and then typically the way that my mentality worked out was, I thought I was always smart. So what I would end up doing is I'd be like, it'll come back. I know it. I know I'm right, and then I just watch my trade bleed and bleed and bleed and bleed and bleed. And I'm just like, ah. And then eventually I got wise to all that and started using data. And then I got introduced to some other traders. And then I got introduced to some professional traders. And then I started working for a hedge fund. And then I was like, holy crap, this is actually the most important thing to all of this. It is not the trade per se, right? There's lots of great trades in the market. It's how you manage those trades. It's how you manage that risk that actually makes you money and actually can make an account grow over time. And I think that that's what a lot of retail traders actually miss out on. There's a lot of systems out there that have a lot of great trades, but there's not enough data behind them, or there's nothing. There's no systematized way behind them to know uh, how to allocate to them properly, how to grow an account with them properly. And in fact, a lot of the time you'll see a bunch of trades out there that are like they're a little bit leaned more into, hey, if you just put a certain amount of money in this every day, it'll make money over time. And you can take a really crappy trade and actually make it somewhat profitable. And I actually have a sheet about that. Let me this will be kind of fun. I know I'm getting off subject here, but let me I've got it in here. You'll like this. At least I liked it. I thought it was fun.
If you guys have any questions too, put them in the comments because we probably will have a little bit of time.
So let me share. All right, so this should be relatively fun here. Um, so this is kind of the way that you know it's not intuitive the way that things work. But so what I've done here is I've just basically made some random brackets, and I've created a cycle of trades that when you've got 1, 2, 3, 4 wins, and I think it might be 5 wins and 2 losses. So I think what I set up here, one, two, nope, it might be 4 wins, 2 losses, 4 wins, 2 losses, something like that. Anyways, I believe it's 4 wins, 2 losses. So the whole deal is that if it's a win, right, we get some sort of winning number, and it's in a bracket, right? And then if we get a loss, it's within another bracket. So you can see here, if we get a win, we're getting a random number between 0 and 30. If we get a loss, we get a random number between 40 and 15, right? So I was trying to keep these in like normal parameters that would be relatively reasonable. And what you can see here is by doing that, if I put in column E, which is this red line over here, what happens is if I sit there and I put the same amount of money in this trade, so I put, in this case, I put $100,000, I think, on every trade. Yes. So I just stick $100,000 on every trade, right? I want to say it's 100 grand. 1 times B3. Yeah. So I think I just put 100 grand over time. Go, 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 go. Well, what's interesting about that is that this is the way it is, and I'm going to change this. So let me change. I think if I just hit enter on here, no, I might have to change one. Yeah, there we go. So yeah, let me do this. All right. So I think it's if I just, yeah, there we go. I knew there was a way to do this without actually messing with the data down here. So you can see I'm just making this, iterate, different functions, and you can see I'm taking on some losses here. But if I keep the trade the same amount of money every time, even in its losses, so somehow I've got this make-believe bank account behind me that I can just pull extra money from when the trade takes a loss, and I can just replenish that and put it back to its original trade size. You can see that makes money over time. So you can take a really crappy trade. By the way, you can see here on blue, right? This is what I mean by a crappy trade. And I try to compound this. So basically what that is I take the win and I put it into the gain, and then I take the loss and I take it out of the next trade, right? So it's scaling up and it's scaling down as you get wins and losses. And there is a little bit of echo, by the way, Michelle. And so the whole deal behind this is if you sit here and take this scaling trade or take this kind of crappy trade back here, we can make it look really positive, right? And this happens to retail traders all the time. They look at this strategy or they find this strategy and you're like, look, if I just put $1,000 in this every day, it makes money, man. It is so strong. But then what happens is inevitably you want to scale it up or you want to grow it or you want to grow your account or you feeling good or you think that it can be scaled and it can't. As soon as you try to scale it, it blows up, right? And then what's actually really dangerous here is for a long time here, this is a lot of iterations, right? I think I've got, let me just see how much data points I got. I think I got, 379 trades on here. And I'm just going to keep changing this randomly. And we're going to find a good situation that is quite funny that will actually show up sometimes. Oh, that was a good one. That was close. It might take me a little bit longer than I was expecting. You can see here, though, across every single one that I do, the compounding one is doing fine, or is dying, and the regular one is actually like surviving here, right? So there's a really good one where you string out really solid in the beginning. So this is like this trade looks so hot and it was so amazing, and then you kind of like keep it at a certain scale, but then you try to compound it and it eventually blows up, right? Like I said, it's not retail traders' fault that a lot of the times they end up losing money. It's because I mean, they didn't know enough about the strategy. So this is a really deadly one. I bet you this one almost blows up. I mean, you go from $100,000 on this strategy that we've been randomizing these things. You go from $100,000 to at one point in time, it looks like we got all the way down to $2,000. So a 98% loss at one point by doing the same numbers that we've been doing just in some random situation. Now it still ekes out profit over the next 30 years or whatever. But man, if you try to scale it, it just blows up, right? It's the same math. Trying to scale a trade that is not designed around scaling will blow it up. And so this is what I mean by, this is also what we're talking about, and making sure that our winners get to the point that we actually assign them their limits on, because if we try to take them down early, you run the potentiality of not being able to be profitable because you're taking your winners too early. You're not letting them run enough and they can't compensate for the losses that you take, right? Those numbers, the balance between the return to risk is super crucial. And then on top of that, the probability of winning. So if you start taking on losses that shouldn't have been a loss, like even what you were talking about earlier, Michelle, with someone not letting the trade breathe today, and we had a fantastic trade. We were over profit target today. Everything was fantastic. It was a great trade, but a lot of a lot of traders end up going, oh, the trade's going so bad because it's down money, and it's actually no. The trade is going perfect. The trade is always perfect. It's always beautiful, and it's always amazing up until the moment it actually takes the loss. And then you can say it took a loss. And then you can go, well, wait a second. Is the strategy doing well? Well, looks like I'm in relative parameters. Everything is beautiful again, right? Tomorrow, let's put on another one, right? That's why a lot of the times when a strategy is actually down near its limits, right, I'll scale in. Right. But that's because I know the limits of the strategies, and we've got data behind all of our stuff, and we've got decisions that are based on data. So yeah, anyways, that's how I do things. And I think that that's a fun thing. If I were to go through here, for the next like 20 minutes, I'm sure I could find one where that strategy up there eventually blows up. But it's, you can make a lot of strategies. Like I said, this is a really crappy strategy that cannot be scaled. But you can turn it into something that looks amazing and, sell it to someone and say, hey, look at this thing make so much money. and you can kind of mess with the math just a little bit and say, yeah, and kind of make it in a way where it's like, yeah, look at this, we do $1,000 a day, and look how much money it makes. So that's where it gets a little screwy in there, and unfortunately, there's a little bit of deception that kind of happens in this situation. But I mean,
So
just look at that. Oh, anyways,
one of the hallmarks of that is strategies where you're only ever trading on half of your account, or there's free money somewhere in the background that if you take a loss, the next month you still only trade on $10,000. No matter what
yeah,
happens, you trade on the same amount of money every month. That is then likely perhaps not actually a scalable strategy. And
yeah.
then what's the difference between a strategy that's scalable and one of these that's not scalable?
What do you
It
mean?
just has
Like,
to
what's the
have better expectancy, right? It has to be a better performing trade.
Yeah, I mean, the way that you can, I mean, there are strategies out there that are scalable, but yet they're presented the other way. So let me kind of clarify that. And that's because when you present them the other way, they look better, right? But if they're a scalable trade and you can scale them up, inevitably the scaling methodology will actually look better with bigger returns. Keep in mind, though, not all trades can be scaled through various reasons, right? Number one, do they have the volume in them, right? Can the actual, underlying asset handle the amount of volume to scale up to a certain size? So, like, inevitably, some of our systems will not be available anymore because we'll either have enough members in it or we'll have ran them enough long or for a long enough time that we basically go, okay, everyone's made a lot of money and we're great. And that's because there's only so much that can be scaled. Now, granted, we're on the SPX, so we're a long time away from that, and the SPX can handle many hundreds and hundreds of millions of dollars, so it's no big deal. But if you are trading something small, like like say individual small cap stocks, and you're trading the opening drive or something like that, that is a very sensitive trade, right? You can't handle a ton of volume in that. And in fact, sometimes by the time that you try to implement a strategy that is told to you, that lag and your price pressure on it because it's so thinly traded can actually create the servicer to actually make the win, and then by the time you try to execute, you end up not getting the win. So or you end up getting a smaller profit or a smaller loss, and then of course your losses are compounded. So it's just this whole spiral. So the whole point behind this is, yeah, the expectancies have to be high enough that they can be scaled, and you have to look at it in a basis of what are your winners to losses and what's that probability, and pull them together. Something that I'll mention that I've mentioned before many times is look at the Kelly criterion, right? Just look at it, right? Stick the numbers in and just see if there's a positive Kelly on it. If there's not a positive Kelly, it'll blow up, right? There's no way you can scale it. If it's a negative Kelly, yeah, it's not going to work. If it's a positive Kelly, it's scalable. How positive of a Kelly is going to determine how scalable it is, and then you can go from there. But
Which are the
you know,
pieces of information that you need to be able to figure out the Kelly?
oh yeah, so you need the probability of a win, and then you need the size of the win, and then you need the size of the loss, and that's it.
The average win and the average loser, right?
Yeah, and I mean you can use average. Average works, So that, yeah, just go with average. If you're not having like a full loss or a full win, then yeah, absolutely just go with an average. If it is always going to be a full win or a full loss, though, which actually Kelly criterion works better for. If it's going to be like, hey, I lose everything, so I lose 100%, and then hey, I make 200% regardless, right? And it's always consistent. That's really what Kelly criterion is designed for. But like I said, even without that, you just punch in those averages, like what you said, and you'll at least get whether it's a positive or a negative Kelly,
Mm-hmm.
and that'll tell you if it's scalable or not. I
Fantastic.
mean, like this situation, this red, the Kelly criterion will give you a total negative number on this.
Should not be going to making a bet on that in a casino.
Yeah.
I don't see
It,
any comments, questions.
well, awesome. Well,
Yeah.
then, I mean, it's roughly about, yeah, what, 30 minutes into this. And I think we crushed through a couple of those really solid questions that some people ask. So we'll wrap it up there and we'll see you guys next week. All right. See you guys. Bye.